Jeff, what's going on, my man?
Hey, Todd, how's it going?
Things are going well. How's
Good,
Florida?
good. Hey, good. It's wet. It rained all day today, but at least it wasn't 104 degrees like we've had every other day.
It actually felt like fall here today, man. It was like,
Oh, did you lucky guy?
yeah, went outside. It was like, wow, it was fresh, nice and cool. Last night was a good night to sleep with the windows open.
Oh, no kidding.
Yeah.
Yeah. We won't have that kind of weather until about October.
Yeah.
At the end of October. So.
Yeah. Usually, I mean, this is a little early for us, this cool weather.
Yeah.
You know, my settlement was pushed back till Thursday.
Thursday? Okay.
So that's when I will be using you guys. And
good.
So I'm excited, man. We're gonna have some fun tonight. You know, one of the things I like about the real estate business is, you know, and I've been in this industry in one form or another for 32 years, you know, and I'm always learning.
Yeah, I hear you.
You know, it's always something new. You know, it's one of those businesses that just never gets old. Kind of the interesting thing too, and I know you've been in the real estate business for a while, in one aspect or another. You were in title, weren't you?
Yeah, I did. Yeah, 15 years. That was in title. That's where I got my start.
Yeah. You know, the interesting thing is, you know, we're like the news people. You know, I mean, people, you know, my buddies, they want to know what's going on in the market. You know, they're calling me up saying, is it true? Should I sell my house? Are things crazy? You know, like I hear what's going on. So tonight we're going to have some fun. Jeff, you know, we appreciate you being on here. I mean, a 1031 exchange is what we're talking about tonight. It's actually named for Section 1031 of the IRS Tax Code. And a 1031 exchange actually allows an investor to avoid paying some, if not all, of their capital gains tax on a sale of an investment property by reinvesting the proceeds from a sale into another like-kind property, a purchase of a like-kind property. And a smart real estate investor could try and use this tax deferment strategy to grow the real estate income, investment income. And, you know, by rolling that initial sale, the profits, proceeds from that into an existing sale, kind of kicking that tax liability down the road. You know, by simply paying a one-time capital gain tax, I guess, when they eventually sell their final investment for cash. That being said, you know, if you're going to go this route as a real estate investor, or if you're even considering it, it's important that you do your due diligence. And guys, it's really important that you hire an expert. In fact, you have to hire somebody known as a qualified intermediary. And these experts just really specialize in the 1031 exchange itself. And an expert like I have with us tonight, Mr. Jeff Stechmann. Now, there are rules that you need to follow and specific time frames to adhere, you know, in order to gain access to these tax benefits. And Jeff's coming from Florida tonight. Jeff's an expert in the 1031 exchange. He is actually the Eastern Regional Manager for a company called Asset Exchange Company. And they're actually helping me right now with my very first 1031. And guys, they've done over 40,000 of these things. So I think we're talking to the right guys here tonight. Guys, I'm Todd Sachs. I'm the broker and founder of Sachs Realty. We are a Maryland real estate brokerage, and we help buyers and sellers and tenants and landlords of both residential and commercial real estate. But we also help people all over the country. So if you need a good agent, you don't have one, you're not represented, reach out. I have an amazing broker network all over the country. I'll be happy to point you in the right direction. Jeff, thanks so much for joining us tonight. Why don't you go ahead, take a minute, introduce yourself to our audience, and tell everybody a little bit about you.
Sure. Thanks, Todd. Yeah, well, so again, my name's Jeff Stechmann. I'm Eastern Regional Manager with Asset Exchange Company. Kind of give you all some information about myself. I've done this for 26 years. Todd and I were just talking. I got my start in the business working on the title side of the business. I'm originally from New Orleans, so if y'all see all the LSU and Saints gear behind me,
did you go to LSU? I guess
no, I didn't. I didn't go to LSU, but I'm a big LSU fan, and but I've actually lived in Florida. I live in the Tampa Bay area of Florida. I've lived in Tampa for 23 out of those 26 years. And, as long as I've been doing this, boy, I tell you, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times too. And, just hopefully we never have to experience those bad times again. Right now the industry is just booming, and, it's great. It's great for everybody. And hopefully we can keep this pace up at least until the end of the year, right? But, I've been specifically doing 1031 exchange. Oh gosh, I dabbled in it on and off, but primarily 6-7 years, something like that. And, as Todd mentioned, he and I are getting ready to do his deal a little later this week. And, we've been working diligently, getting everything set up for him. But, I plan on having some fun tonight. We're going to go over some topics that hopefully everybody can benefit from, and then use them to go out there and build your real estate portfolio.
Absolutely. And that's what we want to help with, help people to maximize their capabilities. And, I got to tell you though, like I was saying, I mean, I'm learning something new every day. This 1031 is certainly foreign to me because I've never done it. I've been a real estate investor for 25 plus years. But I just really started thinking about selling assets off that I've bought, 15 years ago, 20 years ago. And, and what do you do with it? Right. I mean, they have these mechanisms in place that a lot of people take advantage of. So, kind of, Jeff, for those that don't know what a 1031, can you kind of just give a broad overview of the 1031 exchange?
Yeah, absolutely. So, Todd's a perfect example. I talk to people like Todd every single day. He's been in the business for years, buying and selling real estate, and no one's ever even told him about 1031 exchange. Maybe his CPA has never even told him about 1031 exchange, but believe it or not, exchanging has been around for close to 100 years, right? It started back in the 20s with farmers, just to give y'all briefly how it came to being. And back in those days, it was pretty simple how 1031 exchanges worked, or exchanging in general. Maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat. Well, I wanted his farm and he wanted my farm. So all we did is just swap farms. And it was really that simple back in those days. But our modern day exchanges, kind of the format that we follow today, it was really started back in 1979. There was a gentleman by the name of T.J. Starker. Now, Mr. Starker, he lived in California. He owned all this land in California with timber on it. And what Mr. Starker did was he sold that land to a timber company called Crown Zellback, right? And what Crown Zellback did is, in exchange for the land, they gave him what was referred to as exchange credits. And what Mr. Starker did with those exchange credits is, over the course of the next few years, he went out and bought various properties with those exchange credits. And that's really kind of how our modern day exchanges started back in 1979 with T.J. Starker. So if anybody on the line today has ever heard of the term a Starker exchange, right? That's where it comes from some T.J. Starker's last name. I talked to some CPAs that have been in the business for, 20, 30, 40 years. They still refer to a 1031 exchange as a Starker exchange, right? So you may hear that term pop up every now and then. Now, what exactly is a 1031 exchange? Well, when we talk about 1031 exchange, right? Todd mentioned it in the very beginning. The name is actually derived from Internal Revenue Code Section 1031, right? And what that code states is, no gain or loss shall be recognized in the exchange of real property held for productive use in a trade or business or for investment, if such property is exchanged for property of like kind, which is to be held either for productive use in a trade or business or for investment, all right? So what exactly does that mean, right? Well, give you guys an example. Property that you use in your trade or business, you can sell that in a 1031 exchange, and you can purchase any other type of real property that you're going to use in your trade or business, right? We had an exchange for a gentleman that owned a daycare center, right? Now, he was using that real property for his business. So what he did is he sold it in a 1031 exchange, deferred his taxes, and what he purchased in that case was he purchased another daycare center. Because why? Because he was going to use that for his business, right? So that's one part of exchanging. The other part is property that you hold for investment, right? So for like the deal that we're working on for Todd, he has a rental property or rental properties, right? He's holding those properties as investment, right? He's going to sell those rental properties in a 1031 exchange, and then what is he going to buy as a replacement? Well, that's the next part of the code, as I mentioned. There's a thing that's referred to as like-kind property. So like-kind property, folks, is any type of real property that you use in your trade or business or that you hold for investment. You can sell that in a 1031 exchange, and you can purchase any type of replacement property that is like-kind, which is either property that you use in your trade or business or that you hold for investment, all right? So, hey, maybe you have that single-family residential home that you hold for investment, that rental property, right? You can sell that in a 1031 exchange. You can purchase another rental, another single family rather, or you could even purchase as your replacement property a duplex, a fourplex, a condo, vacant land. You could go out and purchase a commercial office building if you wanted to, all right? Residential, commercial, it's all interchangeable, all right? You could even take property that you use in your trade or business. Okay, let's say that same guy that owned the daycare center, right? He wanted to sell that, but he wanted to get out of the daycare business. He could have actually purchased single-family residential homes if he wanted to. All right, so everything is interchangeable. You're not limited geographically where you can buy and sell properties. All right, anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. All right, you also are not limited to how many properties you can sell in a 1031 exchange or how many properties you can purchase in a 1031. You can sell one, you can buy one. You can sell one, you can buy multiple. You can
like
sell multiple.
Right?
Anything.
With me, Jeff, right?
Right.
I mean,
Exactly.
I actually have 4 houses that I'm selling that are on the same block.
Yep.
And they're contiguous houses. And, one of the questions that I had was, hey, can I actually have, they're all under contract with 2 different settlement dates. So I have 2 of the houses that are settling. We're supposed to settle today. Is actually getting delayed until Thursday. And, so I have that closing, and then I have another closing that is happening at the end of August. So we're going to actually attempt to do the 1031 exchange on all 4 of those. And I can take all 4 of those properties, which I've learned, and buy one. So let's kind of talk, Jeff, about, when we're talking about tax deferral.
Right.
This isn't, you're not wiping out, the fact that you need to pay taxes, but, let's just say an investor has a taxable liability. Let's just say that they have $100,000 in what they would have to write the IRS, right?
Okay. Right.
Essentially, I mean, that entire, instead of writing the check to the government, for that $100,000, writing $100,000 check, you're taking that tax liability. We're not talking about the profits, but the actual liability on the profit that you owe. You don't have to pay that right now. You actually take that, add that to your profit, back to your profit. So it's like pre-taxed amount. That's the amount that you're investing. So you actually make money on that loan, tax-free loan that you're getting on the money that you owed, right? You're getting it to make money on. So, I know there are a couple different types of 1031 exchange. So if we could just talk about those, my particular 1031 exchange, and, which I didn't know. And before we even mention that, Jeff, you said something very important. Now, I deal with real estate investors all the time. And, I help them buy rental properties, or I help them sell, cash flow properties, or buy cash flow properties. Everybody says they need an accountant, a new accountant. It's like the common, if I hear it once, I hear it 100 times. They're asking me, do you know a good accountant? I don't think accountants really pay attention or specialize in real estate investors. And they're, so they don't know anything about this particular code. And, in fact, I mean, I've had situations through the years myself with my own accountant where, I needed to step in and ask questions and suggest things because, I was going to pay where I shouldn't have. And sometimes I did, and where I didn't take the right deductions, and even as far as depreciating assets, the actual structure, which we're allowed to do. But a lot of the questions that come is, what comes first in the transaction? Because, like, for me right now, I'm selling assets and I'm going, wait a minute, there's a substantial tax liability. I want to try and use that money legally in the 1031 exchange. But what happens when now I have a certain amount of time to name properties that I want to buy and settle on them? And we're in a market right now where it's very hectic. There aren't a whole lot of properties available, even on the commercial side of things. So, Jeff, what do people usually do? Do they usually first find the property and then sell a property, which I think is called the reverse 1031 exchange? What's the norm?
No, usually the norm. So, what Todd's talking about, there's a reverse exchange, but the most common type of exchange that we see people doing, probably, 90 to 95% of all the exchanges that we do are referred to as a delayed exchange. Now, you may hear another term people refer to it as a forward exchange. And basically, the way they work is you actually sell first. So you sell your relinquished property first, your investment property, and then you buy your replacement property last. That's the most common type of exchange. Again, 90 to 95% of all the exchanges that we do are handled that way. The reverse exchange, what Todd's talking about, is that's actually where you buy first. So you buy your replacement property first, and then you sell your relinquished property last. Now, those can be significantly more complicated than a delayed exchange, okay? The way the reverse exchange works is, with exchanging, you can't exchange into something you already own, all right? So the problem is, if you find that perfect property, okay, well, you can't purchase it yet because you haven't sold your relinquished property. And a lot of times, people need the funds from the relinquished property in order to purchase that replacement property. And also, in order to purchase a replacement property, they may need to get financing. They may need to get a mortgage, right? So with the reverse exchange, what happens is we actually come in and we form a separate company. It's referred to as an exchange accommodating title holder, EAT for short. We come in and we purchase the replacement property before the relinquished property is sold. All right. Now, in order for us to do that, the biggest obstacle to overcome in a reverse exchange is the client has to be able to give us the financing in order for us to do that. Hey, we're a great company, but we're not just going to come out of pocket and buy the replacement property, right? So the client has to be able to give us the funding to be able to do that. Now, typically it's going to have to be cash, right? Because the reason I say cash is because if they're trying to get a loan through a traditional lender, well, traditional lenders at that point, they're not going to loan funds, right? Because, hey, we're not the borrower, the client is, right? We're actually going in title and the client isn't. So that's the biggest hurdle to overcome in a reverse exchange. And we're probably going to talk about this in the next few minutes, but with exchanging, you have to have your exchange completed within 180 days, okay? So when we buy the replacement property, you have to be able to sell your relinquished property within 180 days. And now it's 180 calendar days. That's holidays, that's weekends, okay? If for some reason you're unable to purchase, you're able to sell your relinquished property within 180 days, well, come day 181, you're going to own two properties, all right? So that's the biggest hurdles to overcome.
Jeff, I don't even find that the most unnerving aspect of it as I'm going through this myself. I think 6 months, if you can't buy a property in 6 months, and you probably shouldn't be trying to.
Yeah.
I think the most unnerving aspect is, man, you only have 45 days from the time you close. Like for me, for instance, I have these two settlements, 4 assets. And, so I have one closing this Thursday, one closing in the end of August. So from the day of your first closing, so I want to take all of those properties, buy one asset. And so I only have 45 days.
Yeah. So
Jeff,
here,
we'll go ahead and talk about this. because
Yeah.
there's the 3 property rule,
Yeah.
45 calendar days.
Let me just talk. I'll just talk the general information because we're kind of jumping a little ahead.
Okay.
So with exchanging, okay, the requirements for you to defer your taxes 100% are you have to take the proceeds from the sale, all right, of your relinquished property, and you have to take those proceeds and you have to go out and you have to buy a replacement property, okay, or it can even be multiple properties where the purchase price or the combined purchase prices, if it's multiple properties, is either equal to or greater than whatever that sales price was on the property that you sold. Now, those proceeds from the sale, what are the proceeds? That's the cash, right? That's the cash that normally you would get out of that closing, right? Now, we're what's referred to as a qualified intermediary, right? QI for short. Now, different parts of the country, you may hear people refer to as an accommodator. Another common term is a facilitator, or just simply an intermediary, right? Our main job in a 1031 is we're going to hold those proceeds on behalf of the seller, the exchanger, because the rule is they can never have receipt of those funds, all right? And what do they need to do with them? Back to the rule, they have to take that entire amount and they have to buy a replacement property or a combination of properties, again, where the sales price or the purchase price is either equal to or greater than whatever they sold. Now, from when you sell your relinquished property, this is what Todd started to talk about. From that day forward, you're going to have 180 calendar days to purchase any replacement property or properties. And as I mentioned, that's calendar days, all right? That's holidays, that's weekends. Hey, I live in Florida, all right? Anybody within the eastern United States or even the Gulf Coast, right now, we're in hurricane season, okay? From June 1st to November 30th is hurricane season. If you're getting hit with a hurricane and everything's shutting down for a day or two or a week, whatever it may be, okay, none of that matters, right? That clock is always going to be ticking, right? So you have 180 calendar days to purchase your replacement property. Now, the first 45 days of the 180 days is what they refer to as the identification period. Now, this is where it gets tricky. This is what Todd was alluding to. You have to identify any potential property or properties that you want to purchase by midnight of the 45th day. They don't have to be under contract. You just have to identify any potential properties. All right. Now, that's something else that we're going to assist the client with. We're going to provide a form to you called the identification ID letter. On that form, there's going to be some blank lines. It's going to have to be specific to a property address or addresses. Client's going to have to fill it out, sign off on it, get it back to us by midnight of the 45th day, right? Markets like we have right now where properties are selling sometimes the same day they're listed, that can be tough, all right? But what I tell clients all the time, because sometimes they're on the fence and they're like, well, boy, I just don't know if I'm going to be able to find that perfect replacement property, all right? And I'll tell them this, I say, well, if you close today and you call me tomorrow, at that point, it's going to be too late, because once you have receipt of those funds from the closing, that's it. You've lost your ability to do a 1031 exchange, all right? So if we set it all up for them, at least it's going to give the client another 45 days to keep looking for property, right? If they find the perfect property, they identify it, they can purchase it by day 180, they save all of their taxes, right? If they don't, the only thing they're going to be out of, at least from us, is our fee that we would have charged them the day of closing. Okay.
Yeah, which is what we talked about, right? I had
exactly
the same
right.
concern.
Exactly right. Because, you know, especially like somebody like Todd, like an investor that says, you know what, I already know I want to buy another investment property. Okay. And if you don't do a 1031 exchange, you're going to have to pay whatever taxes are due. Now, what taxes could possibly be due are capital gains tax, which is either 15 or 20%. Just depends on your individual tax filing status. There's also another tax referred to as depreciation recapture tax. That's an additional 25% tax, all right? The way that works is any depreciation that you've claimed in the property for the lifetime that you've owned the property, when you go to sell that property, they're going to hit you with a 25% tax just on the depreciation alone, all right? There's another tax referred to as the Medicare tax, all right? That's an additional 3.8% tax. Now, that may not affect every investor, but what that is, that's a tax that they passed back in 2010 with the Affordable Care Act, Obamacare. It went into effect in 2013. It was one of the things that they passed to try to offset some of the costs of the Affordable Care Act, right? Beauty of 1031 exchange is you can defer having to pay any of those taxes. Now, a state like Maryland, where Todd's located, Todd, y'all have state income taxes, right?
We do.
You do. All right. Another benefit for 1031 exchange. If you live in a state, or even if you're selling property that's located in the state, like Todd, that has state income taxes, you can also get out of having to pay those state income taxes as well, right? Every state kind of has their own way of you completing some type of form or going through some type of process in order to get out of having to pay those state income taxes, all right? So that's the beauty of 1031 exchange. Avoid having to cut that check or checks, and it's just going to give you that much more buying power to go out there and buy a better property. Like Todd was saying, what if he was saying, well, you might be looking at, say, $100,000 in taxes, right? If you don't do a 1031 exchange, you're going to pay that $100,000, and now whatever's left over, that's what you're going to use to go out and buy a replacement property, right? Additional investment in properties. If you do a 1031 exchange, you avoid having to pay all those taxes. That's just going to give you that much more buying power, right? Hopefully, it's going to let you go out and buy a better property. Hopefully, maybe a higher dollar property, higher cash flow. Hey, who knows? Maybe you can go out and buy multiple properties. Like Todd, he's selling 4 properties, right? Hey, Todd might be able to go out and buy 6 or 7 properties. Who knows? Or maybe he buys one prime property and he has more cash flow coming in every single month. And now he doesn't have to manage 4 properes anymore. That's the beauty of 1031 exchange.
Let's talk about the 3 property rule, because
Sure.
I know that's a big thing, depending on, and I do want to talk more when you're saying, like in my situation where I'm selling 4 and you're saying that I could buy 6 or 7,
Sure.
kind of want to address that strategy too, because I think, so what you're saying is that it has to be at least equal to what you sold your properties for. You have to at least buy something of that value. And since
Right.
I'm buying 4 properties, I guess we'll get into that. But
yeah,
what's the 3 property rule?
Yeah.
Because, that's important.
So the 3 property rule, there's actually rules to identifying, right? So remember I just mentioned you have 45 days, midnight of the 45th day, you have to identify any replacement property. So the most common rule that we see investors enacting is the thing that Todd's referring to, is this 3 property rule, right? And what this 3 property rule states is you can identify up to 3 properties without regard to the fair market value of those 3 properties. Now, what exactly does fair market value mean, right? Fair market value is the purchase prices, right? So as far as identification goes, you can go out there and identify up to 3 properties, and the purchase price of any of those properties can be any dollar amount. It does not matter, as long as it's 3 properties or less, okay? Like, let's just say, you're selling property of $1 million, all right? You can go out there and identify property, 3 properties where the purchase price is $1 million each, for a total of $3 million in identification. Or you could be identifying properties that you're buying them each for $10 million a piece for $30 million in identification. Again, if it's 3 properties or less, they can be any dollar amount. It does not matter. Now, sometimes people say, well, what if I want to identify more than 3 properties? Well, you can do that too, all right? But there's this other rule, it's called the 200% rule, all right? Now, it gets a little tricky when you get into the 200% rule, because what that states is you can exceed the 3 property rule, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So basically what that means is, let's say you go out and you identify 5 properties, all right? Now, if you happen to identify 5 properties, you would have exceeded the 3 property rule, right? Because you identified 5, all right? Now let's take that same example. Let's say you're selling for $1 million, all right? You go and identify 5 properties. In that case, it would put you into the 200% rule. And what that means is the combined purchase prices of all 5 of those properties could not exceed $2 million. Now, you may be asking yourself, hey, where is he getting the $2 million from, right? Well, you sold for $1 million, right? So 200% of that $1 million sales price, or 2 times that $1 million sales price is how much? $2 million, right? The IRS doesn't want you going out there and identifying unlimited properties, right? They want you to be really specific in what you potentially want to buy, okay? That's the thing. So you can't just go out there and identify anything. Unlimited, you can't say, well, I'm going to identify everything under the sun, because you know what? You're going to have issues, right? But mostly, most investors stay within the 3 property rule. Again, if you identify 3 properties or less, they can be any dollar value, any purchase price.
So the specific properties, I know that there are, we're talking about investment properties. We're not talking about your personal residence.
Right.
But what about that like kind? So if you have a residential rental, you said you could buy a commercial rental. You don't have to. So where does the term like kind come in?
Well, so that's exactly. So in the code where it talks about like kind property, so like kind property, again, is any type of real property that you use in your trade or business or you hold for investment, is like kind to any other type of real property that you use in your trade or business or you hold for investment. Like kind, it's not the actual property type. It's not residential or commercial or single family or multifamily. It's what you're using it for, trade or business or for investment.
So how about this, Jeff? What if you want to buy, and I understand this is not for a flip, so you can't, I think ideally you have to hold it for a minimum of 12 months. Is that?
A good rule of thumb is to hold it for at least a year, for 12 months.
Right, because you can continue to kick this can down the road. I mean, you can buy something, do some sweat equity in it, build up some more, profit, taxable income, sell it, do it again. I mean, you can continue to do this so long as you can identify the properties and within the time period, and we'll talk about that, whether the current administration makes changes, which is on the table, and I can't wait to talk about that. The Biden administration they are talking about eliminating the 1031 exchange. But anyway, so can you buy a property to develop? So in other words, okay, you can't.
You can't.
Okay. All right.
No, because property that is excluded from 1031 exchange, as Todd mentioned, your primary residence, okay, you can't do a 1031 exchange on your primary, all right? There's a section 121, that's what people use for their primary. And just real briefly, the rules to that are you had to have owned the property for at least you had to have lived in the property as your primary residence any 2 out of the last 5 years, right? And what happens with your primary, if you have any gain when you sell your primary and you're single, the first $250,000 of any gain is tax exempt. And if you're married, the first $500,000 of any gain is tax exempt. That's referred to as a section 121, all right? That's what people use for their primary. But so your primary, you can't do 1031 exchanges on. Property held for sale, you cannot do 1031 exchanges on, like a developer, or let's say you're a builder, right? Let's say you're a builder and you build a spec house, okay? And when that house is completed, what do you do with it? You turn around and sell it, right? Well, because you're holding that property for sale and you're not holding it for investment, you can't do a 1031 exchange.
But what if you were holding it for investment? What if your intention was, you're buying a piece of property and you're going to put an office building on that you want to keep for an investment? Can you? You can't do that.
If you build the office building, and then what happens? Then you get a great offer, and somebody makes you an offer you can't refuse, and then you sell the office building.
Well, that would be the same as if you bought an existing building and somebody made you an offer that.
Well, it could be. Yeah, it just depends. Hey, anything's possible, I guess. If you do a 1031 exchange and you get audited, and the IRS comes in and says, okay, prove to us you held that property for investment and not for sale, you're going to have to be able to back it up. Like that office building. Hey, did you advertise it for lease, for rent?
Yeah.
Did you advertise it for fair market value?
But if your intentions are to truly do that, I mean, you're really trying to build something. And I give you an example. I mean, I'm looking at something as one of my possibilities as something that has a structure on it, but it needs to be torn down and something new needs to be built. And I'm trying to think, hey, can I take this 1031? Can I take the proceeds from it, buy this property that needs to be developed? I'm going to settle on it within 180 days. I'm going to spend a lot more money on it than what I'm selling. It's going to qualify at that, but not necessarily what I sold the property for. So let's just say I'm selling the property for $1 million and I buy a property for $750,000 that I'm going to put $2 million into. Is that something that would work, or that's done because?
Right. So if in that scenario, it's actually what you're purchasing it for. So if you're purchasing it for $700,000, you'd be coming in below what you sold it for. But
so they wouldn't consider a collective price.
No, they don't look at that. But the good news is there's another type of exchange called a construction exchange. Okay. Here we go. This is the way the construction exchange works. Remember in the reverse exchange, I told everybody, you can't exchange it to something you already own, right? So the way the construction exchange works is you sell that building for $1 million in a 1031 exchange, right? Now we're the qualified intermediary, right? The QI. We're going to be holding the proceeds from that sale. But Todd goes out and he finds a property, but it's only worth $700,000. And he says, well, you know what? I want to do some improvements to it before I actually purchase it. Well, what you can do is a thing called the construction exchange. Again, we come in, we form that EAT, exchange accommodating title holder. We can take the proceeds from his sale that he did an exchange on, and then we buy that property, and then with those proceeds, and then we oversee the construction, any improvements to them. Okay. We're working with the contractors handling disbursement. Now we're getting Todd's input the whole time. Hey, this has been done. We need to pay this contractor this amount and so on. Now the thing with the construction exchange, remember the 180 days. Okay, your improvements need to be done within 180 days.
Yeah, that's not happening.
Yeah, well, and they don't necessarily. The building doesn't have to necessarily have a CO. But what those improvements that you've done within 180 days need to be up to that $1 million. Okay. $1 million. All right.
And
so that's what you do.
Engineering and architectural fees and things like that. Is that something that can be put into that?
Maybe. Yeah, maybe so.
Yeah.
All right. But all that stuff needs to be reviewed and it has to be, one of the owners of our company is a tax attorney. All right. He personally handles any construction exchanges that we do or reverse exchanges because they can be so complex.
Yeah.
All right. He looks at them each of them individually, decides on what our fee is going to be based on how complex they are, and so that's more of his baby. But it can be done, if the timing works.
So you had mentioned something about if the IRS comes in and gives you an audit. I mean, are you setting yourself up for that when you do 1031?
No, I wouldn't say so. I mean, I would say this just in general. Very rarely do 1031 exchanges get audited. Like here in Florida, we don't have any type of state agency that oversees qualified intermediaries. Some states do, like California does. That's where our home office is. In California, they have what they refer to as the California Franchise Tax Board. They actually oversee qualified intermediaries. So any file that we work on, they have the ability to audit any of our files. But any exchanges that are done in California, California state income taxes, they look at 1031 exchanges in the state of California. There's a higher probability that you're going to get audited by the state of California if you did an exchange on California property. But in most states, that's not the case.
So let's just kind of go over, one of the things that we discussed, a couple of weeks ago, with the 1031 being on the current administration's agenda. There's been a lot of talk about, are they going to take it away? And, I think, there's no guarantees. I think our mutual friend that, connected us up, who's also in this kind of world, had said, somebody had said, it was like 70-30%, that 30% meaning that the 1031 exchange won't go away, or no, 70% that it won't, and the 30%, who knows?
Yeah, who knows? Who knows?
Nobody knows. I think the biggest concern, at least for me, is because, I have to be careful and wise of my investing, is that if there is a change in the 1031, there is this term called callback, right? Where they could actually go back if they made this change where they eliminated the 1031 in 22, then they could actually go back to 2021 in any 1031 exchanges that happened and claw back, and then you would be responsible, even though you already bought that and spent that money, that tax would be due. So nobody has a crystal ball here, but I mean, we spoke about it, and you don't think that
I mean,
there's a high probability.
They've been talking about eliminating 1031 exchanges for years. All right. They always seem to survive. People ask me that too, because it's all in the news right now. President Biden talked about it in the campaign trail. What ultimately happens, who knows? Are they going to make it retroactive? Who knows? But my best advice is, if you're thinking about doing a 1031 exchange, the sooner you do it, the better, because at any time they could pass it, and then who knows what's going to happen. I mean, things that they're talking about doing is raising the capital gains tax rate to 39.6%. Okay. They're also talking about putting a cap on 1031 exchanges, limiting the amount of gain you can claim if you're single to like 500,000, or if you're married, $1 million. What's actually going to happen? Who knows? But like I said, the sooner you do it, the better. That way, I doubt they would actually go back and make it retroactive, but you never know. A few years ago, like a couple of years ago, when they passed the tax reform bill, in the old years ago, you could actually do 1031 exchanges on real property, but also on certain types of personal property. Okay. A couple of years ago, when they changed the tax reform bill, they eliminated personal property. You used to be able to take, like, personal property was maybe you had a farm, okay, and the farm was the real property, all right, but maybe you had a tractor, that was personal property. You could actually exchange the farm for real property, but the personal property, you could take that tractor and exchange it for another tractor. It was really specific to the it had to be within the same asset class. Maybe you had a hotel, you were selling a hotel. Now the hotel was the real property, but the furniture and fixtures that they had inside the hotel, the personal property, you could exchange that for other furniture and fixtures. They totally eliminated all of the personal property aspect of 1031 exchanging. So now it's just on real property.
So you also said something that is, really important. You can't take a penny of your proceeds when you're settling. And I know there is, we talk about cash boots or something, and you can kind of talk about that. But, if you are considering selling a property, and I have some specific questions here, but if you're considering selling a specific property and you need any of that cash, we're going to talk about that now on, what you have to do. But what you have to understand is, like, Jeff is going to get all of my proceed money, not Jeff specifically, but his company is going to, whatever proceeds I would get at settlement come Thursday, is getting wired to Jeff. And so, one might say, well, how do we know Jeff's legit, right? I mean, Jeff, I even asked you that, right?
That's right. Yeah, that's right. I get that question.
Dude, you sound like a nice guy and everything, but how do I know you're like a real person? And so anyway, all jokes aside, it is important, especially with today's wire fraud and things like that, that that there is actually, a legitimate company that you're talking with that's a qualified intermediary. Jeff, how do they know that you're legit?
Exactly. So, this is a word of caution for anybody on the line today that is considering a 1031 exchange, all right? On a federal level, a national level, there actually is no federal agency that oversees what we do. All right. So what does that mean? What that means is anybody out there can be a qualified intermediary. You're not required to have any type of E&O insurance. You're not required to have any type of bond. There's no guidelines on where you hold the proceeds. There's no guidelines on the type of fund you hold the proceeds in. So, word of caution, if anybody on the line is currently involved with the 1031 exchange, please just make sure you've done your due diligence and you're dealing with a reputable company. All right. Now, with us, okay, I mentioned just a few minutes ago, we're actually are based out of California. All right. San Francisco is where our home office is. Because we're California based, remember I told y'all about that California Franchise Tax Board, all right? That Franchise Tax Board oversees qualified intermediaries in the state of California, okay? They do require us to carry minimums for the E&O insurance we have, minimums for the bond that we carry. I mentioned we're subject to audit by that Franchise Tax Board. There's guidelines on the financial institutions where we hold the proceeds, the type of funds we hold the proceeds in, which is great for anybody that deals with us in California, but anything that we do nationwide, because, we're involved with 1031 exchanges all over the country, okay? That Franchise Tax Board can come into our office at a moment's notice and audit any of the files that we work on, all right? Not just the California property, but anything that we do, all right? So you do have some assurances when you deal with us. And then I also mentioned, one of the owners of our company is a tax attorney. Okay, all the documents that we use are reviewed by him. All right, it's a tax attorney that's preparing all the documents. Another thing with our company is we actually provide free audit support. Right, if a client if they were to receive an audit by the IRS, okay, we would work with the client's CPA helping to defend the audit, and it primarily would be done by our tax attorney owner. All right. So yeah, there is just be very cautious of QIs. Make sure you're dealing with a reputable company. I can provide to people references. If y'all want to talk to our tax attorney owner, he's always the door is always open, to talk to him about anything we do. We have guidelines on how we handle clients' funds, that type of thing. I can provide that to people if and when they ever need it.
Jeff, and one of the questions that I had early on was, can my accountant be the QI? Can my lawyer be the QI, the qualified intermediary? And
right.
There has to be a level of separation, right? Is that?
Yeah, there is. Yeah. So to qualify as an intermediary, you cannot have a previous agency relationship with the exchanger. So like your CPA, your attorney, your realtor, okay, that's the qualifications. It has to be basically like a third party independent, which that's where we come in.
So when we're talking about proceeds, and depending on how you all set up your rental properties, I know some do C corporations, others just have it in their personal name. Others do LLCs, that kind of thing. A lot of times we are lending the company, so to speak, your investment company, our cash. Sometimes you log it. And by the way, neither one of us are accountants, don't claim to be. Always seek competent legal advice and tax advice. But I know a lot of times, you're taking your own cash, and however you log that on the books for your rental property, you may have a lot of your cash in this property that is getting tied up in the proceeds. It's not just profit. You have your cost. You might have a loan that you owe the bank, and then you may owe yourself $20,000, $50,000, or whatever it is. And so a lot of times you're thinking, hey, look, if I'm going with the qualified intermediary and I can't get the cash at closing, Jeff, are there ways that you can place liens on your property or second liens that would actually be, I know this is kind of going out there, but I was thinking, a property should always, my attorney always says a property should always be encumbered. So let's say I go out and I buy a property and I pay cash for it. And then, he always says, well, why aren't you putting a lien on the property, even though it's yourself? Because, if something were to happen, it's encumbered and the property's not sitting there free and clear. So in my situation where I'm selling these 4 assets and I have a loan on the books to my company, my LLC, if I had recorded a lien for that amount of money, I could have probably taken that cash to clear the title and gotten back my initial investment at closing. Right, wrong, maybe?
Yeah, that's a good CPA question.
You can tell I'm thinking, man. I'm like,
yeah.
I want at least something
Gosh,
back, man. I want to close, but I want some money in my pocket too.
But I'll tell you this. You mentioned there is a way you can take some of the proceeds out. All right, Todd kind of briefly just mentioned the term. It's referred to as cash boot. So I'll give you all a quick example of maybe the way that can work, right? So let's say out of the proceeds, okay, you don't want to use all of those proceeds towards buying replacement property. All right, let's say you want to hold some of it back. Let's just say you have proceeds of, I don't know, $500,000, okay? And you say, well, you know what? I want to take $100,000 of that. I want to hold it back. And I only want to use $400,000 towards buying my replacement property. Now the difference, I'll make that up in a mortgage. Okay, with $100,000 that you hold back, you can do that, but you're going to be subject to taxes on that amount. All right, it's referred to as cash boot. All right, BOOT, boot. All right, it doesn't mean you can't do a 1031 exchange. All right, what it means is instead of you getting a full deferral, you're going to get what's referred to as a partial deferral. Now, partial, why? Because you're going to be paying some taxes on that $100,000, that cash boot, all right? Typically, the taxes that you pay on that boot, the cash boot, is going to be significantly less than if you just sell the property outright and you don't do a 1031 exchange, all right? Now, the $100,000, you can do whatever you want with it. You want to pay off bills, you want to go on a great vacation, you have a child starting college. If you want to go to Vegas, you want to blow it all gambling, all right? You can do that with it, whatever you want to do. But remember, you're going to be paying some taxes on it, all right? Now, what I tell people is like, look, if you ever want to do anything like that, you really need to talk to your CPA. Because why? Because you really need to know your numbers in that kind of situation, because you have to look at it and say, okay, if I don't do a 1031 exchange and I just sell my property outright, well, hey, what's my taxes look like? But if I do a 1031 exchange, but I take some cash boot out, what's my taxes look like? Again, usually that tax is going to be significantly less. But if the CPA comes back and says, you know what, man, that tax is actually going to be greater than if you just sell the property outright, guess what, folks? Don't do a 1031 exchange, all right? It's not going to be worth your while. You're going to lose money, all right? Because there is some break-even point. If you take too much money out, all right, or if you go down in value, because if you go down in value, okay, that's another thing. If you go too far down in value, the difference you're going to be subject to taxes on, that's referred to as mortgage boot, right? So two types of boot, mortgage boot and cash boot, all right? Again, always talk to your CPA, make sure you know your numbers, make sure it's going to be worth your while.
And Jeff, the other thing, and I know this is probably a CPA question too, but another thing that, we had talked about was, can someone buy that, that exchange? And then at what point could they refinance that exchange and take money out at that point? Is there a
right? Yeah, that's a strategy that some investors do. So they'll do the 1031 exchange, get the full deferral, buy something equal to or greater than, use all the proceeds towards buying property equal to or greater than, and then maybe they'll wait 6 months to a year, then they'll refinance and pull some money out. That's a way that you can get some money out without having to pay taxes on it. But what I tell people is like, look, you wouldn't want to refinance a week after you did your exchange, because again, boy, if the IRS comes in and you get audited and they say, wow, you did a 1031 exchange, but a week later you refinanced and you pulled all the money out. Remember, you have to, with 1031 exchange, you have to be able to show that the property that you're purchasing, that you're holding it for investment, right? Your intent is you're holding it for investment. In that case, they would say, well, your intent was just to pull the money out. You never had any intention, you avoided the taxes because you did a 1031, but then a week later you pulled all the money out.
Yeah.
Okay.
So, and Jeff, you answer this for me, but just for anybody listening, the question that I had was, can I buy something out of state?
Absolutely. Yep, absolutely. So yeah, again, you can buy you can buy and sell real property anywhere in the United States, including Guam, the U.S. Virgin Islands, or the Mariana Islands. All right, so you're not limited geographically where you can buy and sell. And again, you're not limited to how many properties you can sell or how many properties you can purchase in a 1031. Sell one, sell one, buy multiple, sell multiple, buy one, buy multiple. Remember, the thing that matters with 1031 exchange is whatever you're selling, you have to use it real property for your trade or business, and you have to be, or you're holding it for investment, all right? And you have to purchase real property that you use in your trade or business or that you hold for investment.
And Jeff said to me, just make sure that you check with your accountant to make sure that at your tax filing that your state, if you are to buy out of state, just make sure that your state is going to still defer those state taxes. You know, like I'm here in Maryland, my accountant said that, you know, if I bought something out of state, because I live in Maryland, anytime I go to sell that state, I'd be paying Maryland tax anyway, if I'm still a resident of Maryland.
That's
so
right.
He was saying that Maryland does defer the taxes as well in a 1031, same as the IRS.
Right.
Even if I bought something out of state. How about vacation properties, Jeff? I know that's kind of like a, you know, questionable thing.
Yeah.
So if I were to buy something in a beach town or, you know, oceanfront, and it was something that I was going to Airbnb, is that qualify as?
Yeah, it can. Yeah. So, you know, I'm located in Florida, right? So I get that question all the time because I'm in Florida. You know, everybody in Florida either has a vacation home or wants a vacation home. So the guidelines for vacation homes, what the IRS says is, and this is actually referred to for everybody, if they have any CPAs on the line, it's referred to as Revenue Procedure 2008-16, all right? And what the guidelines state are, you must own that vacation home for a minimum of 24 months, for 2 years, okay? And then what they say is for every 12-month period of ownership, okay, you must rent the property out as a minimum of 14 days, all right, for every 12-month period of ownership at fair market value, all right? Now, you can use it for some personal use. What they state is for every 12-month period of ownership, you can actually use it for 14 days personal use or 10% of the total time that you had it rented during that 12-month period, all right? So I'll give you guys an example. Let's just say during that 12-month period, let's say you rented that property out for 200 days, right? So 10% of 200 would be what? Would be 20 days, right? So you could use that property for 20 days personal use instead of the 14, right? If that property meets those guidelines, it qualifies for 1031 exchange. Now, the question that Todd said, well, what if it's like Airbnb? What if it doesn't exactly meet those guidelines? I wouldn't necessarily say it would be disqualified. In that case, again, I would say talk to your CPA, all right? Because if you and your CPA can come to an agreement where you feel like you can justify that property as being an investment property, then hey, by all means, use it in a 1031 exchange. We're always going to recommend to people, talk to your CPA. Because why? Because your CPA is going to have way more information about your tax situation than I ever would. I would even want to know, okay? If the CPA comes back and says, yeah, hey, I think we can make the case it's an investment property, then, you know, for us, move forward with it, all right? We're not going to overrule what your CPA does. I mean, because ultimately, who's going to be the one that's going to be signing your tax return is going to be that person. They're going to be signing off on it. They have to have some agreement to, you know, because if you get audited, who are you going to turn to? You're going to turn to your CPA and say, hey, we're getting audited. We need to defend this. Okay.
Yeah.
Yep.
We do have a question here. Christopher's asking, without the intermediary services, when you file your taxes under an LLC that purchase investment real estate, can you purchase tools, pickup truck, or just equipment off the proceeds of the sale for future use on real estate projects and write off the vehicle or equipment, tools, etc.? That's a very good question.
That's a good CPA question. Yeah,
that sounds like it. Yeah, that's an awesome question.
So if you didn't do a 1031 exchange without the intermediary services, when you file taxes on LLC, yeah, hey, that's where you want to run by your CPA.
I guess
you know
so.
what you can.
So Jeff, what if you use an intermediary? That's almost like a farmer deal, right? You have a tractor. What you talked about is,
Yep.
Before the tax reform. I mean,
Yeah. Yeah,
Chris,
you can't. So if you did a 1031 exchange, we're the intermediary, right? The only way you could do that to buy tools and so on, you'd have to take money out. Now, what's that money that you hold back from the proceeds to buy the tools and everything? That's called boot, right? Cash boot. You'd be subject to taxes on those amounts.
But listen, so if you buy that Airbnb, and I mean, could you use the money to furnish it since they have to be furnished? No.
Nope.
Gotcha.
It's only what you're buying it for. That's all personal property. You can't use it unless you want it to take money back, and then you're going to be subject to taxes.
Yeah.
On it.
Yeah. Interesting. Wow.
Right.
So much good stuff, man. Good information. So Jeff, I mean, anything else you want to add here? I mean, you have any anything that we missed that you think is really critical?
Let me see. I know we had talked about a few things. Just taking a look at my list. I'll mention something about the thing with 1031 exchange with the step up in basis. All right. This is something that, it's been around for a long time. It's a benefit that some investors use that it doesn't really get talked about a lot with 1031 exchange, but with exchanging, okay, you're not limited to how many times you can do an exchange. Okay, you could buy an investment property today, right? Hold on to it for a period of years. Let's say it's a rental property, sell it at some point, do a 1031 exchange, defer your taxes, buy another replacement investment property, hold on to that for a period of years, sell it again in a 1031 exchange, buy another investment property, right? With 1031 exchange, you can keep doing that over and over the entire course of your lifetime. Okay, now what happens when you die, okay, when you pass on, if you have any heirs that inherit your property, okay, your heirs are going to get what's referred to, a benefit referred to as a step up in basis. And basically what that means is whatever the value of the property is when they inherited it, all right, that's their starting point. That's their basis. All those deferrals, those tax deferrals that would have been done over the course of the lifetime of the person that they inherited the property from, basically they go away and no one ever has to pay the taxes. All right. So if y'all remember anything about today's talk, remember that. All right, because it's a really great aspect of 1031 exchange that it doesn't really get talked about that often. For me, here in Florida, we have so many retirees that want to move here, right? They want to move here and they want to buy investment property and live out the rest of their days. Again, it's perfect for people like that. All right. Now, here's an example of the way the step up in basis works. Let's say I'm the heir, right? I inherit that rental property, right? Now, for me, for my own investment purposes, I may look at it and say, gosh, this is a great property. Now I get the step up in basis. I'm not responsible for the taxes, but for my own investment purposes, I say, gosh, that's a great property. I'm going to hold on to it because maybe it has some nice cash flow coming in every month. Now, let's say I hold on to it, I don't know, maybe for just maybe 5 years, right? And then after 5 years, I say, okay, now I'm ready to sell the property. Now, if I have any gain from when I inherited the property where I got that step up in basis, to when I go to sell it 5 years later, guess what? I can do my own 1031 exchange, defer my taxes, and basically start that whole process over again. Okay? That's a great benefit with 1031 exchange.
Yeah,
especially
Jeff, while you were talking, I had two thoughts come to mind.
Okay.
So when and they're probably very simple, and I know the answer, but I'm going to ask it anyway. So, a lot of people that are buying real estate, it could be a pass-through entity, right? Where even if it's an LLC, it's coming to your personal taxes anyway, any profits and things like losses and things like that. If you're selling a property that is in the name of an LLC, do you have to purchase that new property in that LLC name?
Yeah, so it just depends. All right, if it's a pass-through entity, meaning that you don't file a separate tax return for that LLC. A lot of times we see that with, let's just say it's a single member LLC, okay? So, and for tax purposes, it's referred to as a disregarded entity, a pass-through entity, meaning that anything to do with that LLC, you're just going to put on your personal taxes. You're not going to file a separate tax return, right? So with 1031 exchange, it's important to remember whoever that taxpayer is in the sale needs to be the same taxpayer in the purchase of any replacement property or properties, all right? So if you have that pass-through entity, that disregarded LLC, if you sell that in the name of that disregarded LLC, you actually have the option when you do a 1031 exchange to purchase it in the name of that disregarded LLC, or you could even purchase it in the name of the individual. Because why? Because
could you create a new LLC?
You could absolutely do that too. Yeah. Sometimes we see this. Sometimes people go out, an investor will go out, and let's say they buy 1234 Main Street, right? So what do? They create 1234 Main Street LLC. You may have seen that, Todd. You may have seen that in your real estate career, right? It happens all the time.
I've done it myself.
All right. So, but what they do is they don't file a separate tax return for 1234 Main Street LLC. They just put anything to do with that LLC on their personal taxes, right? Now, they hold on to that for a period of years. It's an investment property, right? They go to sell it. They want to do a 1031 exchange. So they do a 1031 exchange, and the replacement property that they buy, let's say they go out and buy 5678 Central Avenue. Well, guess what? They don't want 1234 Main Street LLC buying 5678 Central Avenue. So what do they do in that case? They go out and create 5678 Central Avenue LLC. That's also going to be a disregarded entity, meaning what? They're not going to file a separate tax return for that entity either. They can do that because why? Because all of those disregarded entities, those LLCs, are considered one and the same with each other, and they're also considered one and the same with the individual because why? It's all being reported under one tax return. All right, now here we go. Here's the thing with the corporation or partners. Okay,
that was the next thing.
Here we go.
So
here we go. Me and Todd, we're partners in a partnership. We own a building together. It's an investment property, right? Now our partnership files a separate tax return, right? And the partnership will issue K-1s to Todd and I. Then we take that information, we put in our personal taxes, right? But because that partnership is filing a separate tax return, that's actually referred to as a regarded entity, all right? If that partnership sells that real property in a 1031 exchange, that same partnership has to be the purchaser in any replacement property or properties. Because why? It has to be the same taxpayer, right? Todd and I, we could never sell that property in a 1031 exchange, and then I try to go buy a property as an individual. Todd tries to buy another property as an individual. We could never do that because why? Because we don't really own that property. Our partnership does. That's the legal entity, the taxpayer, right? So that same taxpayer has to buy the property as in the 1031 exchange. Now, there is another type of ownership structure. Let's say Todd and I, we want to go buy a property together. We're not going to form a partnership. We're going to take title to it as what's referred to as tenants in common, all right? Tenants in common ownership, for those of y'all that don't know, is you can actually own a certain percentage of a property, right? So Todd and I go out, we buy a property 50-50, tenants in common ownership, where I'm going to be a 50% owner, he's going to be a 50% owner, all right? We buy that together, we own it for a few years, and at some point we say, okay, yeah, we're ready to sell this property. Now, let's just say for me, I'd like to take my 50% tenant in common ownership. I'd like to do a 1031 exchange because I want to defer my taxes, and I'd like to buy another replacement property, an investment property. But for Todd, he says, you know what? Yeah, I don't want to buy any more investment property. I'm fine with just cashing out, paying whatever taxes are due, okay? He has the option to do that. I also have the option to do what I want to do. If I want to do a 1031 exchange, defer my taxes, purchase replacement property, Todd could even do his own 1031 exchange if he wanted to, defer his 50% and go out and buy a replacement property of his own, okay? We could even do this. It could even get more complicated than that. What if I didn't want to buy my 50% in my individual name? I create a disregarded LLC. Todd creates his own disregarded LLC, and the LLCs own the 50-50.
So let me just complicate it a little bit more then. I mean, while we're talking, it's crazy because, we had a sales meeting today and we were going over some different things and some different numbers and some strategies. And I turn around and I, look at the agents and I say, did y'all understand that? And they're like, yeah. And I'm like, well, did you really understand it? Or, do you really understand it? They're like, no, we're with you. And I'm like, because if you're talking to anybody else about this stuff, they're like, what? What are you talking about? But, if you're in the investment world and you've been doing this, I mean, chances are you're following us so far.
Yeah.
If not, keep listening and subscribe to our channel and we'll teach you more later. But anyway, how about this, Jeff? So let's say I sell a disregarded entity, that single member LLC. And now I call you up and I'm like, hey, Jeff, let's buy this property together.
Sure.
You weren't involved with my 1031. Can I defer still?
Yeah, you can do that. Yeah. So, all right, let's work some numbers. I'll just keep it simple. Let's say you sell your property for $500,000. All right. So Todd has a property he's selling, an investment property selling for $500,000 in a disregarded entity, right? Meaning Todd and his entity are considered one and the same. So he sells it for $500,000. Let's just say, keep it simple, he nets $250,000, right? So what are his rules for 1031 exchange? He has to take that entire $250,000 and buy a replacement property equal to or greater than whatever you sold. So that would be, he'd have to buy a property for at least $500,000, right? That's the rules. Now, if he says, well, Jeff, let's buy a property together, we'll be 50-50 tenant and common owners. No problem. We go out and buy a property for $1 million. Okay. Todd's going to meet his exchange fully because why? Because he's going to only own 50% of that $1 million sales price, right? What is that going to equate to? $500,000. Okay. Maybe we go out and buy a property for $2 million, but it's not going to be 50% ownership. All right. Whatever Todd's ownership out of that purchase price needs to be equal to at least $500,000, whatever percentage that is, as a tenant and common owner. Okay. If we want to bring another person in, it's going to be three of us that are buying a property as tenant and common owners. Todd needs, whatever his percentage has to be, at least $500,000 or greater. Okay. You can work it any way you want it. You can, hey, a corporation wants to be 1/3 owner. Another disregarded entity wants to be a 1/3 owner, and Todd wants to be a 1/3 owner with his disregarded entity. You can do it that way too. All right. Remember, taxpayer. Todd's the taxpayer. He has to be equal to or greater than whatever he sold, whatever that percentage of ownership is. Does that make sense?
Absolutely. Yep. Yeah, that's perfect. I'll tell you what, guys, I brought him to you tonight, didn't I? I mean, Jeff, he knows his stuff. So, we'll make sure that we publish all of Jeff's information in the show notes. He'd love to hear from you. If you're interested in a 1031 exchange, you can follow along with me. I'll let you know how everything goes. We closed on our first property that we're going to attempt to do a 1031 this Thursday. Another property within 30 days. I'm going to do everything I possibly can to make it within my 45 days to identify my properties. We'll see how it goes, guys. But Jeff, man, you have been great. So full of information. Thank you so much.
Thanks for bringing me in, Todd. Hopefully everybody got something out of tonight.
Yeah, absolutely. And guys, we appreciate you watching along. If you haven't already done so, like, subscribe, follow us on whichever your favorite audio or video platform is where you find this podcast. And until next week, have a great week.
Thank you.